Nothing said on Forward Guidance is a recommendation to buy or sell any investments or products. This podcast is for informational purposes only, and the views expressed by anyone on the show are solely their opinions, not financial advice, or necessarily the views of Blockworks. Our hosts, guests, and the Blockworks team may hold positions in the company's funds or projects discussed. All right, everybody, welcome back to another episode of Forward Guidance, and we are recording live here from Permissionless IV in Brooklyn. It's about 100 degrees, but we're not letting that get to us too much. But super excited to be joined today by Sid Powell, CEO and founder of Maple Finance. Sid, great to have you on the show.
Thanks for having me on, Felix. Long-time listener, so glad to finally be on an episode.
Yeah, appreciate it. I mean, You guys are killing it. Really great to get you on the show and pull you aside. I know you're on a panel earlier, so busy day, but yeah, should be fun. So for those listening that don't know about Maple Finance, we'll get into that in a second, but I would love to just hear about your journey because it's under my understanding that you came from the TradFi world, and we'd just love to hear about what you worked on there, what was your journey like, and how did you end up in crypto?
Good question. So I come from traditional finance space. I used to work in banking, so I was in one of the large commercial banks in Australia, National Australia Bank, and while I was there, I was doing a kind of an esoteric thing called securitization. But what it meant is I would help lending companies to borrow. So they would borrow really large amounts, break it into smaller amounts, and then give home loans and car loans to their clients. And so I was doing that for a few years, but I really wanted to be more of a startup kind of entrepreneurial environment. Obviously, that's a massive bank, so it's kind of the other end of the spectrum, 10,000 plus employees. And so I went to a smaller commercial lending company, and I was managing their treasury. So that meant I had to line up their finance, so help them borrow so they could give out loans to their clients, which were small businesses. And it was kind of, while I was there, I met my co-founder, Joe, and that was when I kind of first started getting into crypto. So this is like 2018, and then it was early 2019 that we wrote, the first white paper for what is now become Maple. But at the time, the idea was just doing tokenized bonds on chain. But it was so early that there was nothing to tokenize. There were no real investors on chain, and the concept of financial products was so early that they were still having a debate around whether DeFi would be called decentralized finance or open finance. Right. That's how long ago it was.
Yeah, fair enough. And yeah, that lending space in crypto feels like it's been through a lot in the last 7 years, to say the least, and you've been through every version of that basically since the creation of it. So I would love if you could just walk through the original conception of Maple, because to my understanding it was a under-collateralized lending situation, and that was quite common at the time throughout the crypto industry, and it's also, to my understanding, what led to a lot of the big cascades of defaults that happened during 2022, 2023, the FTX stuff, the Genesis stuff, all of that. So we'd love to hear, what was the design philosophy in the beginning there, and how was that within the context of the rest of the crypto industry at that time?
Yeah, a lot to unpack there. It was, you're quite right. So we came into the space doing under-collateralized lending. And the thinking was we had to meet the customers where they were. So if we had tried to come in 2020 or early 2021 with another over-collateralized lending product, it was already oversaturated in the DeFi space. You had Compound, Aave, Maker. And then in the CeFi space, it was even more oversaturated. You had Celsius, BlockFi, Genesis, Voyager. And so we really would have struggled to compete. So we came in with a differentiated model where we focused on having, multiple pools run by what we call delegates, but effectively like credit fund managers. And we focused on pooling capital and then doing loans to market makers who we felt were underserved and they didn't want to borrow over collateralized. And so that gave us a natural set of customers. And because T-bill rates, people forget what an impact interest rates have on the crypto space. Because T-bill rates were basically zero at the time, any yield was good yield. And so you came in, you're doing under-collateralized lending, you're getting anywhere from 10 to 15% initially, and then later 6, 7, 8%. But people were super hungry for yield, and they had a very high risk appetite. So the combination of those things allowed under-collateralized lending to really flourish. And I think what happened is, obviously you had kind of some lax credit practices, and you had a couple of event-driven triggers that cause a deleveraging. So you had Terra Luna, 3AC, Celsius, and But a lot of what allowed that to happen, like the significant amounts of leverage, where one, you had those kind of retail deposit takers, so they could aggregate capital and lend it out the same way the banking system does. And two, you had a flood of VC capital into the space. So, at one point, Celsius had raised 700 million, right? So that capital has to go into something. It went into the lending book, it went into some of the other products they were doing. But it was the combination of the macro factors, the super high risk appetite, and then and then also the lack of prior major credit events. So people weren't stung by that, and it took us a couple of years as a space to really recover from that.
Yeah.
If you look today, there's really still very little leverage in. At the height of 2022, there's probably 55 billion in loans outstanding. Now I would say we're still less than 20 billion.
Yeah. That's so interesting. It's so true to describe the fact that we are so used now so quickly to the fact that we live in a world that's no longer ZERP, that we actually have a durable structural yield, and that was not the case back then. And I just, as you mentioned, that just had this like reflection, this almost PTSD moment of just when SBF was on like the Outlaws podcast, and he described DeFi as like a black box. And so the question for you is just like, what were the sources of yield at that time? Because to your point, we're in rates of zero. Hey everyone, this episode is sponsored by Ledger. For the past decade, Ledger has been the global leader in digital asset security, trusted to secure more than 20% of the world's crypto assets. Celebrating 10 years of innovation, Ledger is making digital ownership more secure and accessible with their latest products, Ledger Stacks and Ledger Flex. These wallets feature the world's first secure touchscreens, simplifying your digital transactions while ensuring uncompromising security through Ledger's secure chip and proprietary OS. Plus, with the Ledger Security Key app, you can say goodbye to traditional passwords and step up your digital protection. Your entire crypto experience got a whole lot easier. Ready to protect your assets? Choose the most trusted name in hardware wallets, Ledger, and take control of your digital security today at ledger.com. All right, back to the show. As always, investments in blockchain technology involve risk, terms, and conditions apply. Do your own research. In the case of our business, so the yield that Maple was producing, it was arbitrage profits and market making deal profits from market makers. So if you look, the major clients that we had were larger market maker firms like Wintermute. We also had some hedge funds on there, but effectively they were trading volatility and doing market making deals. And also a lot of them were running the basis. Remember, the basis hadn't been tokenized yet, so it's it's a couple of years before Athena. And so you had entire hedge funds that were set up just to do the basis because it was inaccessible for traditional finance. And so a lot of people were just doing that as well. So those were like the major yield sources for us. And then for other players, there was a combination as well of things like yield farming, new tokens were being generated all the time. There was this whole phase where food tokens were really big, right? You had yams, pickle, sushi, and a lot of those obviously, went to zero in the end. But at the time, they sustained a lot of the yield as well. Yeah, interesting. And so nowadays, I would say it's much more of a sustainable form of yield. And that's probably why the overall borrowing appetite is still much lower than it was in 2022, is there's just not as much sustainable yield to support paying interest on loans. Yeah, 100%. So that would have been a fascinating time to just navigate through. Obviously, there's just counterparty risk left, right, and center. And that must have just been quite the experience to navigate through. I'd just be loved to hear how did Maple come through that so strongly? Because if we fast forward to present day, you guys are killing it. Like, we'll get into that in a minute, but you guys went and persevered through where there was a lot of dead bodies that were left back there in 2022, but you guys are doing fantastic. So what was that process like to navigate through that and just to have the tenacity to keep moving forward? So I think there are a few things at play in how we survive that. So there's And to put it in context, so I think across the Maple platform, over all of 2022, there were 2 borrowers who defaulted, and we managed to miss Alameda and 3AC. So we dodged some of the landmines there, but also we were run as this kind of platform model where you had the credit managers making the decisions. And so I think one of the structural reasons that we survived is that you had segregated pools where a default in one would not commingle or trigger a default in the other pool. So that helps. That was a structural element that we've tried to carry forward into what we do today. And then the other element was, to a certain extent, the manual underwriting helped us. So
the fact that we were doing under collateralized lending on the platform meant that you had to go and look at the borrower's balance sheet, and that was what allowed us, and the underwriters on our platform to decline 3AC. They produced financials a couple of times that didn't add up, and then they also had a massive red flag, which is when the entity structure abruptly changes. So people who were the owners before are now replaced by the wives of those people. That's usually a red flag coming from a banking background. And then with Alameda, we saw the same balance sheet that everybody else saw. But, we saw these tokens on there that were marked on there at, a few hundred million of their value, like just the amount that Alameda held. And, if you've never heard of it, how can it be like a multi-billion-dollar token? And so we, the underwriters on our platform stressed those to zero, and then also gave no credit for FTT. Like, I can't issue Sidcoin and then count that as equity on my balance sheet?
Yeah.
Like, that's crazy. But that was what they were doing. So it looked like they had a $14 billion balance sheet with, 8+ in equity. But if you subtracted FTT from there, it was like $1 billion on equity carrying more than $10 billion in debt. And so, the underwriters on the platform wound up the loans to them, like 4 or 5 months before they eventually went under. But I think the discipline was instilled by the fact that it was under collateralized lending, so you had to pay more attention to the balance sheet. And so, where we are today, nowadays we focus more on over collateralized lending because all of the similar to like why do we go into under collateralized lending to start with, very competitive. And then post-2022, very uncompetitive. There was a total lack of supply there, and so we just stepped in and kind of filled that.
Yeah, that structure that you characterized there of just, foreign concept in crypto, but just real humans doing actual due diligence and not just relying entirely on permissionless protocols. There's a delicate balance there, and I would love to just hear some more context on the decisions made to actually pursue that, because in the crypto world, like if you compare something like Aave, these permissionless vaults, where there isn't as much of that dynamic. So what were those design decisions to actually focus and prioritize and actually having this proper, just human due diligence and custody, and how did that, save you and give you an edge?
Well, I think there's a set of institutional clients who don't want to deal with something that's entirely algorithmic and permissionless, and that's expressed in different ways. One of the ways it's expressed is that a lot of these larger institutions hold native Bitcoin, and they're not willing to wrap that Bitcoin because they think it's a taxable event. And so that automatically rules them out of using things like Aave and Morpho. And so we've tried to kind of go where we think the competition is weaker and where we can be differentiated. And, if you look at, if you look at who we view our natural competitors as being in the traditional finance space, the major ones I would point to are probably Ares and Apollo. So these are asset managers who focus on credit, and that's kind of where we, want to guide our puck. And so, if we'd had to purely compete in an algorithmic way, it would be very tough to come in and compete with an Aave or a Morpho or a Spark. But by being differentiated, we actually get the opportunity nowadays to partner with all of them. We are Syrup USDC, so our yield-bearing dollar product is integrated on Morpho. There's been a temperature check on Aave, and then Spark has also integrated us. So by being different, we're actually able to complement them rather than being a kind of pure competitor with them. But I would say that what we've tried to do overall is our North Star has been like, how do we serve kind of institutional clients, and what does the product need to look like to make it attractive to them? And then the other thing is just where can we be differentiated? 2023, we had this, we had like a come to Jesus moment where we were looking at things like tokenized T-bills, and obviously Ondo got very early to that space, but then there were a series of fast followers, and we tried a product like that for a while, but we couldn't differentiate ourselves. So there's 15 competitors. Nobody makes any money on that product at the moment. Everybody's waiving their fees. There's no revenues on it. And so we were like, we've got to get out of this product. It's a red ocean. We've got to get somewhere where people are not competing.
Yeah, makes sense. So, okay, now we're in the present day, and I would love to just take a 30,000-foot view here, and just for our audience that isn't as much in the weeds in the crypto world and understanding the lending space, just if you could characterize where we're at today. So we already talked about how there was a lot of under-collateralized lending back then because that's where the demand was. Now we're in this world of over-collateralized lending. We got a Fed funds that gives us a durable yield on T-bills. and some other interesting structured products around that as well. So would love to just have you, just paint the picture on where the industry is at today in terms of just like digital asset crypto lending.
Yeah. So let's focus on a few different aspects. So in terms of size, as I mentioned before, we're actually much smaller than Maple is much larger than we were previously, but the lending space is much smaller than it was previously. So you've seen a contraction in the CeFi lenders. Now the CeFi lending side is actually dominated by Tether. So size is much smaller. Composition, DeFi versus CeFi. Before, heavily dominated by CeFi. CeFi lending 55 billion in 2022 in loans outstanding. Nowadays, probably 15 total. So down by a factor of 75%. And DeFi lending is much, much larger than it was in 2022. So you can see that people's risk appetite and also where retail capital could go has totally shifted. Retail capital can now only go to DeFi because folks like Celsius, BlockFi, they're not around. So DeFi has grown significantly in terms of market share and importance. Risk practices, I would say overall much, much safer than they were back in 2022. So not just because under-collateralized lending is much, much less, but the collateral now that you see tends to be posted in tri-party accounts. So you have much more involvement from kind of solid enterprise-grade custody solutions. So size is different, smaller, composition much more DeFi weighted, and then risk management is definitely much more evolved than it was before. The other thing that's coming in now that is, I think, a very positive catalyst for the space is more institutional participation. So we announced a few weeks back a deal with Cantor. So this is obviously a very well-established TradFi name who's lending against Bitcoin, and we've seen appetite from names you would never expect to look at BTC-backed lending. Now, setting up project teams and looking at the space much more seriously. So I think overall, if we really want the space to grow, you need those institutional balance sheets to come in. So I think that's a positive tailwind.
For the skeptics that hear that, oftentimes you'll hear them say, crypto is just repeating the past mistakes of financial markets that we've repeated over hundreds of years or whatever. So my question to you is, what of that entire world that you just described is uniquely interesting for those that are listening from the TradFi world that are saying, what's going on in the DeFi world, what's going on in the crypto world that's actually uniquely new and interesting and innovative that the TradFi world might be interested in adopting? Because it feels like, right now all everybody can talk about is stablecoins. That's obviously one that's hit a lot of momentum. But what else in there is really new and innovative that can be actually transferred into the TradFi world?
It's a good question. And I think there's often a lot of pressure from commentators in the TradFi space to say, you have to blow them away with something that's 10 or 15x to get, to even be allowed to exist. And I don't think that's the way innovation works. But I would say stablecoins are a tremendous innovation. I don't know that I need to kind of relitigate why they're important. But if we look at some of the other benefits from doing this on chain, I think transparency is really paramount. So the fact that our loan book is on chain, so you can always check the performance and how many loans there are, validate that they're out there. But
hey everyone, this episode is sponsored by Ledger. For the past decade, Ledger has been the global leader in digital asset security, trusted to secure more than 20% of the world's crypto assets. Celebrating 10 years of innovation, Ledger is making digital ownership more secure and accessible with their latest products, Ledger Stacks and Ledger Flex. These wallets feature the world's first secure touchscreens, simplifying your digital transactions while ensuring uncompromising security through Ledger's secure chip and proprietary OS. Plus, with the Ledger Security Key app, you can say goodbye to traditional passwords and step up your digital protection. Your entire crypto experience got a whole lot easier. Ready to protect your assets? Choose the most trusted name in hardware wallets, Ledger, and take control of your digital security today at ledger.com. All right, back to the show. As always, investments in blockchain technology involve risk, terms, and conditions apply. Do your own research.
Moving beyond that, you end up with better liquidity by doing it on chain. So the fact that you can have secondary markets through things like Uniswap or other kind of swap protocols, I think is a big advantage. And the fact that your assets become kind of portable across DeFi. So I think that composability is a big it's a big word that means a lot of things, but how I think about it is it encompasses things like secondary liquidity. That's really important. It's really hard in TradFi, particularly in private credit. Private credit a lot of that just trades OTC between banks, whereas now you're able to have these products that can trade fractionally on chain. And anyway, just to keep moving in terms of the utility side of things, as an example or a bit of a case study, so we have Syrup USDC. We launched that less than a year ago. It's now got over $1 billion in TVL, but it's permissionless, which means you can push it out into any kind of DeFi integration. So where is it used today? Secondary markets, so you can exit the position instantly. You don't have to wait to redeem. You can use it as collateral to borrow and kind of lever up your position. Now, TradFi might say this is actually a horrible use case. You shouldn't be levering things, but if we look at the history of levered returns, right? Like where does private equity sit? And then the other one is hedging interest rates. You have something like Pendle where you can say, I actually just I'm comfortable with this current return. I want to lock it in, and something like Pendle allows you to do that. These are all products that there's no specific product for that in TradFi. There's just various fragmented desks and traders that you have to go to for that.
Yeah, totally. Yeah, it's interesting. I mean, when you look at the history of financial crises, it feels like one of the key catalysts of them to really accelerate is just counterparty risk and not knowing who your counterparty is, and rehypothecation of assets. And so I'm curious if you've seen any evidence in this world that we're in of just open source blockchains where you can see your loan book, to your point. Do you see that as the potential for at least solving or improving that dynamic of just the fact that you know your counterparty, you know what their exposure is, could just overall lessen the temperature during those heated moments?
I think so. I mean, we had a borrower the other day, they posed Bitcoin to us and borrow dollars, and they said, this is the address we thought the Bitcoin was being held at. It seems like the Bitcoin's moved. Can you tell us where it is? And so we gave them an updated report of where their collateral's sitting. But imagine you couldn't conceive of that in traditional finance, right? Because it would just be a ledger entry where I tell you, I've got your Bitcoin in an account, but I can't actually ever prove that it's there until I return it to you. And so in that way, most of TradFi is actually just built on layers of counterparty risk, where over time the players have become such behemoths that they're single A, double A rated, and so you just take it for granted that they're going to be there until you have some kind of spectacular tail risk event, and one of them is not. That makes them in the long run, kind of brittle systems. And so I think that's the opportunity for DeFi and for doing this on chain, is that you can end up with a system that is more able to withstand those kind of shocks. There's no like JP Morgan who can collapse and take down the entire crypto system. It'll survive in the same way that it did after Alameda and all these other players kind of went under in 2022. But I do think that it is really important to have that transparency, and I think over time that'll be reflected in effectively lower costs of financial products. On a historical trend, finance takes up, in my mind, too much a part of the overall GDP. I think historically it was like 5 or 6%. Now it's closer to like 10%. And I think that's largely reflective of the fact that you've had regulatory capture, too much industry consolidation, and so you've basically had profit taking at the expense of consumers. And so if there's one positive benefit we see over time from doing this on chain, it's that you see finance being a smaller percentage of the overall economy.
I was going to ask about that, because it feels like if we start to bring all assets on chain, capital efficiency is just going to go through the roof, and then funding costs. So you agree with that?
I do. I agree with that broad thesis. I mean, the way I'm looking at it is I see a lot of organizations that are kind of slow and stilted and very bureaucratic, and similar to Jeff Bezos, I think the best defense is a low cost type model, and we want to treat their margin as kind of our opportunity, and that's ultimately that's the single best incentive you can have to bring customers across is offer a product of comparable quality, hopefully better quality, but cheaper. And you really hit a home run if you can offer a better product that's cheaper. And that's one of the reasons I think stablecoins are finding such product market fit, right? Instantly settle money anywhere in the world at a fraction of the cost of sending a wire or sending something through Swift, and that's over time how we're going to have to win and attract customers. You can't really get around that.
100%. So present day Maple V2 focuses a lot on fixed rate lending, which really helps for your durability. And I would love to just unpack the dynamics between comparing and contrasting the current space in terms of the fixed rate lending space and the variable lending space, and where that stands, because it still seems like the variable rates lending space is still much larger, and people just seem so much more, attuned to it. But the fixed rate lending space is super interesting to me, and especially when we start to combine the two. I don't even know if we're in a world right now where we have swaps. Do we? In that space,
swaps between fixed and floating.
Yeah.
Very basic, but nothing commonly used.
Yeah,
for sure.
Yeah. So it's just like an evolving space that this is already existing in the TradFi world, but as we talked about the benefits of bringing it on chain, where does that sit right now in terms of like the fixed rate versus variable rate world of crypto?
I can give the background for the reason it exists, and so if you were to do fixed rate, you have to have, at a fundamental level, you have to have somebody say, okay, I agree that this is a good rate. Like I'm willing to take this rate. And that means having a human agent somewhere in the decision-making process. And so that has worked really well for CeFi lending. And so most of centralized lending is actually probably, I would say, fixed rate. Although if you look, some people are going SOFR plus a spread, which is more conventional variable rate. But didn't work at all for DeFi protocols. If you wanted to have something algorithmic, you had to have an interest rate that moved with utilization so that you could balance demand and supply without having a human involved to say, we think that the fair market rate is X. And so that's why it's been really slow to develop in the more visible area of lending, which is the DeFi lending space. So Aave, Sky, Spark, Morpho. You're seeing, for what it's worth, all of our lending is actually fixed rate.
Right.
So when market rates change substantially, it's both a pro and a con. So when market rates change substantially to the upside, we're slower to respond, and so we lag the market a little bit. However, when rates are declining suddenly, our rates will be slower to move than, say, an Aave or a Morpho or one of these other lending protocols. And so that means that you get a higher rate. Your higher rate is stickier, and it takes longer to come down. So our customers like that.
Yeah.
And it's also more predictable for our borrowers.
What's the typical duration of like your fixed rate?
We do a lot open term with a 30-day recall period. So it means generally you can get your money back within 30 days, but often we have a really high velocity of deposits, so you can actually just be redeemed by new deposits coming in. Nowadays, though, as the space is getting more institutional, we're seeing the requested timeline, the requested durations for loans stretching out. So now we've got a $100 million loan in our pipeline where the borrower wants it for 12 months because they're like, I've got to fund my business for 12 months, right? Like I need to lock in certainty. But the other thing I was going to say is you're starting to see fixed rate lending kind of happen on chain. Most recent example is probably Morpho Labs. So they're setting up what is best described as like a central limit order book for lending. And so I'm interested to see how that turns out. They're going to have the issue of fragmented liquidity. Like how do you get an order book to a sufficient scale where it's actually interesting for people to use? And that's one of the reasons that we went vertically integrated. So we no longer had kind of outsourced underwriters because it's much harder to make those kind of marketplace dynamics work.
Interesting.
Diverge.
Yeah, totally. So looking into the future of the crypto industry and the lending space, I'm curious about what you're super interested in. You already mentioned the fact that you have some really interesting big institutional heavyweights like Cantor that are coming into the space.
Yeah.
And you're well suited to be an intermediary there. But yeah, what are you most interested in terms of that? I know you have a lot of you're focused pretty deeply on Bitcoin right now in terms of the lending space there as well. So yeah, what are you seeing? What are you interested in?
So we've tried to concentrate our business around the larger caps. So if you look, when we were smaller, we could do more hand-to-hand combat, and we had to look at things like DeFi tokens. Now we kind of focus on BTC, ETH, Sol, XRP, ADA, like large caps, hype increasingly. Yeah. But the other things that we're kind of focused on, we actually have a BTC yield product. So we run a staking strategy in partnership with CoreDAO, one of the BTC L1s. I think that's really interesting and complementary to our lending business because it means that I can actually offer borrowers a lower rate if I can stake their BTC. Sol, we could actually offer Sol-backed loans at 0% because we could stake the Sol. And so if you're looking to borrow to buy a house, think about that. You get a loan to buy a house, no money down. Or not no money down, but no servicing cost. And so if we can bring down the dollar interest cost for people posting Bitcoin, that makes us much more competitive, will help us grow. And then I'm starting the other thing that we're focused on is, my background was securitization. So we're looking to put together more of these kind of structured facilities, which I think will allow us and others to bring in more TradFi investors. So, we saw Cantor, but a lot of them are still very risk averse. Even if they're over collateralized with Bitcoin, they're kind of risk averse. And so, to get an insurance company in, you probably have to offer something with extra risk protection. That means things like structured facilities or securitization. So we've actually got a couple of proposals in the works there. But I think I'm really excited by that because it can bring more traditional investors in and give all of us in crypto the benefit of a wider audience. And then some of the things on chain I'm paying attention to, AI kind of always lurking there. Nothing to call out kind of right now. And then restaking. I've seen people start to mention restaking being used as, call it default insurance or first loss protection. So I loosely keep an eye on that. I've been talking to a few of the restaking teams around that. But they're looking for a use case. And if you think about it, their product was effectively repackaged catastrophe insurance, right? Like fundamentally, restaking is an insurance product. And so they're looking for things to insure, and credit is a large market.
Yeah, earlier in the conversation, you mentioned Athena and just the structured product of basically a funding rate packaged in. What do you see in that realm in terms of, what's so great about the DeFi world is it's just so stackable. You can take your the Maple yield and then add on potentially like some sort of funding spread on top of that too. So
we tried a structured product earlier in the year. We caught Bitcoin at a bad time where it was going flat to declining, but the product was, Felix, let's say you got $1 million. If you gave it to us, we could give you a floor yield of 4%. So you're pretty competitive with T-bills. But if Bitcoin ripped, we could give you up to 33% yield on it. And we could do that by buying effectively a call spread. So we used options to get you leverage on it. And the underlying source of the yield was our over-collateralized lending. So we used the yield on the loans to purchase the options. But we caught Bitcoin at a bad time, and so it was going down. And but that type of product, we actually got interest from parties we weren't expecting. Like a corporate treasury was like, we can't really buy Bitcoin because what if it goes down? But we're all super bullish on the space in Bitcoin, so what if we buy this? And then we get the upside of Bitcoin, but it's in dollar terms, and we're not taking the balance sheet risk. But I think structured products are going to be massive. They are already massive in private wealth spaces. You look at like what JP Morgan, private client practice and Morgan Stanley sell. It's a lot of structured notes. And I think if we really want to evolve the space, we're going to have to do that.
Yeah, totally. As we talk a bit about institutions coming into this crypto world, one that we haven't talked about yet is treasury companies, which seem to be also all the rage right now. Everybody and their mother seems to be launching one right now. Started obviously with MicroStrategy and Michael Saylor, and now we just got this proliferation everywhere. So I'm curious, what's your high-level read on just that evolving industry? How does that co-integrate with the lending space and what you do at Maple?
Well, I think, it's like the first one is super innovative, and then by the time you get to the 20th version, you've kind of hit farce. And we may not be there yet, but we're probably approaching that. And so I think of it as it's an expression of like the mechanism for these to occur is that there is a NAV premium. The reason there is a NAV premium is that Bitcoin's not necessarily an investable asset in every part of the world. Maybe now in the US with the ETFs, that's far less of a problem. But in other jurisdictions where they don't yet have an ETF, you could easily make the case that this is a good retail vehicle for them. But I think there's obviously also like what's causing the supply. Well, people want to get rich issuing these things. I take a kind of measure. I think we try to take a balanced approach where we're working out like how do we sensibly participate. And the way that I look at it is we can complement them by being a flexible source of funding in their capital structure that sits above the convertible bonds and above the equity, but we allow them to purchase Bitcoin or ETH or Sol or Hype or XRP when they think prices are opportunistically dropping, and they use the treasury assets as collateral. And we can do it because banks will not lend to them, so we can be differentiated, and we can be complementary to them in that they can access funding from us, Maple, much faster than it takes to issue a new convertible note, and probably less costly. Because if you're really bullish on their equity, you think their equity is the most expensive thing, and that's what they're issuing a lot of. I think where we have to be careful and where they should be careful as well is you don't want to paint a target of like a liquidation price for them. And so I would always say do it very conservatively. Don't go take an 80% LTV loan. Do it much more conservatively, but then it becomes like anything. It's a tool that you can use well or you can use poorly, but it gives them a way to differentiate themselves. Yeah. And it's worth noting, Saylor had a facility like this in 2022. He returned it when the banks, the regional banks started collapsing in 2023 and switched to just capital markets. But I think there's a place for us to play. And I also think that a lot of these companies are going to get very competitive in trying to get a yield then on their assets. And that'll be phase 2.
Yeah, makes sense. Yeah, I mean, it just feels like you just can't stop the human psychology of just wanting to lever up and speculate. And, you get the one thing and it works and, you know, and then you get the 10 copies of it. And obviously you've been through the last cycle of crypto where we saw a lot of that. And how do you feel about just in high level terms, as somebody who just feels like a very pragmatic and nuanced person in the crypto space, and you guys have survived through these and flourished, like what are some of the high level themes, philosophies, values that are just important to navigate through that world where we're just we're never going to not see these cycles of just like huge leverage and then this unwind, and it's just a part of human nature. So how do you navigate that?
Simple question. Finishing with the easy stuff. So I think being in crypto, there's obviously a lot of speculation. I read a lot of history, and so I liken it to other historical industries, whether it was railroads in the mid 1800s, cars and automobiles in the early 1920s, semiconductors in the 60s and 70s. And so I think any new industry that's pushing the envelope is going to attract some charlatans and snake oil salesmen, and so you just have to expect that that's going to occur. And I think too many people think, the fact of their existence means that you need to shut down the industry or slow it down. I don't think that's the case. I think that's Darwinian. I think what's kept us in it for the long term. Obviously, we went through some pretty significant challenges at the end of 2022. We had to cut 40% of our team. Everyone who stayed had to take pay cuts, and so we had to manage morale through that, and then find a new kind of core product to get product market fit with, which for us became overcollateralized lending. But I think the biggest kind of North Star for me and for my co-founder has been that we are building for the long term. I don't have the view that Maple is something we just do for a couple of years and then you sell your tokens and you ride off into the sunset. I aside from you guys, aside from Forward Guidance, one of my favorite podcasts is the Founders Podcast. And the guy there just instills you repetitively that most of the gains come in year 20, year 30. You look at Jensen Huang, most of his net worth has come in years 40 plus of him being CEO of NVIDIA. And so it's just like, it's inculcated in my brain that most of the benefit, financial, the material benefit of doing this is going to come, 20 years from now. And so you have to survive to that point. And so, if you play stupid games, you find stupid partners. And so I've always focused on the lens of what decision would I make if I wanted to be doing this 20 years from now, and then just kind of follow that. So it keeps you away from doing short-term pump and dump type stuff, or, selecting for the short term over the long term. Yeah, nice. I love that mindset. Well, Sid, really great to get you on Forward Guidance finally. Thanks for having me.
Congrats on all your work, and appreciate it.
Awesome. Thanks for having me.